guys, welcome back to the Capital Mindset Show. If you guys notice a little bit, some things are different. I'm trying new things, trying to see if you guys respond well to it or not. So the background's hopefully a little bit less noisy, a little bit more focus oriented. So today the video is going to be about Adobe. And they just actually reported earnings. So we actually saw the stock pull back a little bit, but in the grand scheme of things, the stock has pulled back actually quite a bit. And we'll actually take a look at the price action right now, and we'll head over there. And then we'll take a look at some of the investor presentation as well, as to what they kind of said about the earnings call. What are the focuses of this business? So for those of you who don't know, Adobe is a very, very, very large software business, actually a very important business, something that I use their products quite frequently. They expand into, some analytics products. They also have Photoshop, Adobe Premiere. These are the Creative Cloud products that a lot of consumers have a lot of experience with, but they have a lot of enterprise solutions. We have Adobe Sign as well. So all these different products or suites that Adobe is basically offering to their enterprise customers make Adobe a very important business in the business world. Okay, so not only do you have the consumer facing side that you may be familiar with, but there's also the added aspect that the enterprise side that you may not have direct experience with, but doesn't mean that it's not there and not extremely important. Okay, so Adobe over the long term has absolutely dominated. If you see 196,000% increase since its IPO. So absolutely demolishing market returns. And you can kind of see here, it has a nice drop of about 37%. And this was kind of in the broader sense of the overall beginning of the liquidity crunch, and then exacerbated by the fears of the conflict. So they didn't have the same liquidity crunch that we were talking about in this channel early on. I mean, we saw like a little hiccup here, but they didn't really experience it because, again, this is not the canary in the coal mine, as we so to speak, in all the videos that we've talked about in the past. So for those of you who've been with the channel for a long time, you guys know what I'm talking about. This is a very well-established business, so it's always going to have the after effect after these, so to speak, canaries in the coal mine have shown you what is to come. It would experience that afterwards, and it was definitely at a premium price point. I think we'll actually take a look at that when we get to the valuation. On a GAAP basis, you can see here a PE ratio of 42.87. So that's with GAAP net income. We'll obviously take a look at it in the form of cash flows, what that means. But just on a glance, it looks expensive. But of course, that's relative to how much it's growing, right? And when I say growth, I mean the underlying business fundamentals growth, right? Not the stock price, right? So the stock price over the last 5 years has done tremendously well, about 231%. And again, over the last 1 year, we see actually down 8%. And again, we saw some really good performance earlier on, and then we saw it just correct here. Okay, so now the question becomes, today, is it a good purchase? All right, well, let's take a look together at the financial statements, and we'll kind of decide that together. And just a quick glance, right? We're not going to really delve too deep into the 10K, but enough that we can get a basic idea. And this is actually the first time that I'm taking a look at this, so we can look at it and you guys can see my thoughts raw live. Okay, so we do see a good cash position. Cash is coming down. Could be because they were making necessary investments to grow the business. That's not necessarily a bad thing at all. It's more of a good thing, in my opinion. Short-term investments. Okay, so that's, for example, that's like short duration bonds, et cetera. So basically cash assets. So current assets totaled about 8 billion. Actually, it's an increase in current assets. So we see where the increase occurred. It increased in short-term investments. While there was a decrease in cash equivalents, there was an increase in short-term investments and trade receivables. Okay, and then prepaid expenses, just a small increase there. So overall, current assets are actually up. All right, so the business is actually more flush with cash, so to speak, and cash equivalent assets, right? And when I say that, I'm being a little bit more broad there, not in the literal accounting sense of cash and cash equivalents. I'm actually including in that definition short-term investments like short duration bond instruments and stuff like that. Okay, we take a look here. Goodwill is actually a decent chunk of the assets. Not too nice there. I don't really like that too much, but nothing to be concerned about. Total assets are totaling about 27 billion. Goodwill only makes up less than half of that. Okay, so we're still on the good end, but that's probably mostly due to the acquisitions they've done over periods of time, and kind of added to that suite of products that they offer to the consumer. All right, so let's take a look at that debt. debt is very sustainable relative to the cash pile that they have. And again, I'm taking a look at the cash and cash equivalents and short-term investments for sure. And so they can easily pay that debt off if they really wanted to. They probably aren't going to because they want to be efficient. Okay, breaking down the revenue. I remember back in the day when Adobe was making the switch over to a subscription-based model, a lot of people were concerned. And then there's actually, I can kind of point this out. There are some companies that were going through that transition that we have spoken about a little bit, not in too much in focus. There hasn't been like a dedicated video to it, but Splunk was another one that is making the switch over to a cloud subscription service versus the licensing service, right? And so Adobe made the switch a while ago at this point, and now they are benefiting, they are reaping the rewards. We see tremendous amount of growth. And again, a lot of people just think, oh, Photoshop, oh, Adobe Premiere. No, Adobe is a very encompassing business and actually has a lot to offer to enterprises. So when we see this growth, this is not Photoshop, all right? I don't want you to think Photoshop. I want you to think all these other suites. And I actually implore everyone to go to Adobe's website and actually look at the products. You click on it and you can see all the product offerings that they have. And then you'll actually probably notice that they offer a lot of things that you probably never heard of because they are enterprise solutions, not really consumer facing solutions. Okay, so taking a look here, the subscription is going to be very high margin. You can see there that the cost of the subscription. Okay, so just real quick on the, let's actually head back. There's a little bit of an interruption there. All right, so taking a look again at the cost of the subscription revenue, it's very low. So that's an important metric to actually keep track of or understand this business. This is a software business, so we're going to expect to see high gross margins, okay? And then again, we see product costs are also extremely low versus the product revenue there. But revenue for product is decreasing because they're trying to shift everyone over to the subscription model, which allows for more steady revenue streams, right? More predictable, a little bit better. Investors tend to favor those a little bit more. We will see, typically, you will see a higher premium to subscription-based businesses rather than businesses that have their revenues a little bit more lumpy. It's a little bit easier to evaluate, and definitely the investor base does appreciate it a little bit more. Of course, we see research and development dedication increasing over time. This is a good thing as long as it's being spent well, but generally speaking, it is a good thing. We want to see them, again, keeping up with the competition. Adobe Premiere, Photoshop right now, they are very, very good, very compelling products. A lot of professionals use them. Of course, if there are free options, there are very cheap options, and there's always competition going to be. But again, that's the consumer facing side. They have a lot of enterprise softwares that, you know, a lot of enterprises are, you know, favoring them. And we know, for example, DocuSign, HelloSign, but there's also Adobe Sign. Adobe Sign is actually growing fairly well, and they are making a compelling case as to why you should use it. For those of you who don't know, you know, you probably use PDFs all the time. Well, a lot of companies, they pay Adobe so that they can have PDF editor and stuff like that. And that's very important for a lot of businesses. For example, in the business that I work with, that's used a lot for contracts. And then actually they just segued into and made a compelling case for why my employer should use Adobe Sign, so that it's very easy, seamless integration. And yeah, that I can speak on that front, but again, Adobe, very important business. All right. So this is consolidated comprehensive income. We'll skip over here to the cash flow, statement of cash flows, and we can see how much cash they're actually generating. And again, this is a positive cash flow flowing business. We're not, you know, investing in a startup. We're investing in, this would be a very well-established software giant. Okay. And now looking down there, they are producing a tremendous amount of cash flow. Now, we see that the cash flow they're producing is greater than the net income because, again, the net income is a GAAP metric on the accrual basis of accounting. So it depends on how they're evaluating, but over time, over periods of time, they should kind of even out. Okay. So we are, of course, removing non-cash expenses from the word that were included in the income statement, but we're removing them in the cash flow statement or the statement of cash flows because obviously it's not a cash expense. Now, some of those obviously are expenses over long periods of time, but we can reflect those in different ways, such as CapEx, for example, for depreciation, right? And we want to distinguish between growth CapEx and maintenance CapEx. Okay, so for the most part, let's actually head over here to the model and actually see what's going on. ADBE, and we shall wait for the model to kind of pull the data forward. But yeah, I expect, before we see the numbers, I do expect this to be, you know, fairly maybe pricey on the pricier end. And we're going to include the average buybacks to be about what they averaged out. We see that they've grown about 21%. So let's actually add that as the high end. And if they grow at 21%, the cash flows, we are in the buy range at the market rate of return. Okay. So if I want a small margin of safety, we're in the buy range. All right. If they're going to continue that growth rate. Now that growth rate it can be quite aggressive, but it is possible. It is a possibility. Okay. So let's kind of see what happens if the growth rate does slow down a little bit. Right. So 15%, maybe we put the 15% in the middle, and then let's put a 17% in there. All right. 17%. And for less than that, let's actually say, a 10% or maybe a 12%, then a 10%. I think that's fine. Okay, so from here, we can see that we're kind of there with a 17%. I think if we assume an 18%, it'd be fine. Yeah, it'd be fine. All right, so between 17 and 18% is where we'd have to kind of expect this. Let me actually go here and slide over, because I know some of you like to look at this. You guys can pause the video here and take a look at the pay structure, if it's publicly available, and when they were born, what gender they are, if you care about that. But no, I actually am kind of surprised. It's not as overvalued as I thought. Again, we aren't assuming a much of a margin of safety. So I think, Adobe it's not, this is one of those where it's a fantastic business, right? And we'll take a look at the ratios, because I bet you before we get into these ratios are probably gonna be really good. So current ratio, really good. I won't, again, hold them to task on the cash ratio. That's a very conservative measure. I don't necessarily want to see that, not want to see it. Of course I want to see it, but like, I don't punish a company because it's not above 1. Okay. And then we look at the total debt ratio. Total debt ratio is fairly strong. Okay. It's always less than 50%, except for 1 year, slightly above 50%. But for the most part, very manageable. Long-term debt ratio, very manageable. Debt to equity, very good. Financial leverage, very good. Interest coverage, amazing. All right. So good all across the board. We're not looking at some chump company. All right. And then look at that gross profit margin, again, indicative of a software business. We have 86, 86, 85, 86, 88. Operating margins, again, rising as well. Net profit margins also rising, but then 2020 was an anomaly, very high operating margins. And then let's take a look at the earnings quality. Earnings quality is consistently above 1. Love to see that. ROIC is fantastic. Look at that ROIC. All right. So return on equity, return on assets, all these are good. So this is indicative of a fantastic business. Okay. So let's take a look at the sentiment score. It's fairly positive. And then we see Adobe can easily hit 600. This is from Seeking Alpha, CNBC, et cetera. You can kind of pause here and read these articles. You can even, by the way, you can even search these articles up. When the final product or software is available, you guys will be able to just click the link and just go there, and it will show all of it. And then I will basically put in a way for someone to select how much articles you want to see, like the most recent 20, most recent 30. And then we could even add sort of like maybe potentially a filter. So you don't want to see like CNBC. I don't like CNBC. Then we can filter that out. But for now, it just shows everything that's talked about. And then we see that more recently, there's mentions on Twitter, Reddit, none on StockTwits, none on Yahoo Finance. But, that's fine. Mostly the sentiment is pretty positive. And I think for what I'm seeing here, the article sentiment is also pretty positive. So for the most part, sentiment is positive in the article sense and in the average person sense. Okay, so pretty good there. Nothing crazy. So I think for me personally, it is a business that I would be very interested in. I'm actually fairly interested in buying Adobe. I think that the price could be better. But what I'm going to do is I might start an initial position at any point in the near future. And it'll just be like a watcher position that I'll kind of nibble into. That's how I operate a lot of positions, by the way. And I can take this time to actually segue into that and kind of explain myself a little bit more, because I get a lot of questions in different videos as to how do I enter a position? How do I exit a position? For the most part, it is fundamentally driven. And sometimes I do acknowledge, for example, that a business can be a little bit on the higher end in terms of price, but I still might buy into it a little bit here and there. And it's kind of to get myself started for a feel. And again, this is an art and a science. It's not just art or just science. So I don't have like an absolute strict method that I follow for every single business. I follow a method that helps me remove a lot of the emotions from investing. But for the most part, it's not all clear, cut and dry as to I always follow this methodical, instruction manual. Okay. But for the most part, I'm going to be buying a little bit of Adobe here and in the next coming days. And By the way, I'm still going to make videos on Thor Industries and Netflix, and those actually will be coming out. I'm taking the time because I have a lot of time on the Sunday, so I can film those for you guys. But for the most part, Adobe is it's a great business, and it's not at a terrible price, right? And so I think I want some exposure to Adobe on this pullback. It's not, again, going to be a big position unless it pulls back significantly. And that's how I kind of manage the risk. It's the size of the position. And if I see a really fantastic price on a fantastic business, I increase the allocation to it, right? And I have money coming in, monthly, and then I can allocate that capital as I see fit. And if Adobe remains at a good price or gets to a better price, I will allocate more capital in that direction. I don't think that Adobe is a fantastic price here today. It's not a fantastic price. I think it is a fair price. And when I say fair price, if we take a look again back at the assumptions I'm making here, is I'm asking for a small margin of safety. And with some of these growth assumptions, I see that it's basically there, but I'm not that comfortable with it. So when I say it's a small position, it will be probably less than 1% in the beginning, just to get, again, the feel for it. It'll make me psychologically pay more attention to the business, because I'll be able to see it actually more often than not. And again, I'll be hoping for a lower price, so then I can escalate the size within the portfolio. All right. And then, of course, if we want to ask ourselves, well, what is that size? Well, I'd ask for a bigger margin of safety. And I think we could get one if we see some fear priced into the market and we see this pull back. And I think it could quite easily, depending on what occurs, a $200, $300 price tag. Okay. And in that range, I'd actually be very comfortable with building a position in Adobe. And I'd say, about 250. And again, remember the Facebook video, or Meta at the time, I stated my price points, and it was at like 300. And I think I don't know if a lot of people thought it would actually get below 200, and it did. So it didn't get to the gulp range where it was like 160, but it got really close, guys. It got really close. And again, a lot of people probably never would have thought that it would have gotten there, but that's, again, where I mix the art and the science, right? So I have my strategy that I put in place ahead of time so that I remove a lot of the emotions, right? It's very easy to look at something like Adobe, and maybe you can comment down below if this happens to you too. Look at a company and then you get infatuated with it. You get emotionally attached to it. It becomes like you build this relationship with this company, and then you just want to buy it, and then you don't care what price it is. You get into the story-driven side of the investment. And yes, I love that. You need to have both, right? And I think I spoke about this extensively in the video where I had a subscriber come on and he interviewed me. And then I kind of expressed those ideas that you have to have a little bit of both, the analytical side and the story-driven side. You can't let one take over your methodology, but having a little bit of a balance is good, because when you own a business, you want to buy it at a good price, and then you need to understand what it is that you own, right? And that comes with the story, right? You need to know, okay, well, what is Adobe doing? What are they doing to distinguish themselves? What makes them so great? And then you feel a sense of pride for owning it. But then you're not so foolish in the sense that you're just looking at that and not caring what you pay for it. Then that side comes in and says, okay, well, these are the fair prices that you should be buying. And then they kind of mix together. And when you blend it, you make this perfect harmony of knowing what you own and buying it at a good price, right? And then your confidence will build up, and you kind of know more or less, you'll know more or less when to scale back the position or when to add more to the position. All right. So those are my price points. I think I'd be very interested in Adobe. Again, you're probably going to see it in the public portfolio coming, in the next coming days, for sure in the next week. And there actually is another position that's coming in, I reorganized the portfolio actually, and you guys probably will appreciate that. I'll probably do a portfolio update video when these new positions are in, but if you guys go on it now, you see it's organized actually from strategy. And I think you guys might like that. If not, let me know. I'm open to changing it. It's literally just a quick click for me. So it's not a big deal. All right. On that note, guys, I hope you guys enjoyed this video. If you guys did enjoy the video, go ahead and feel free to leave a like. If you have any questions, comments, concerns, critiques, go ahead and comment that down below. And I'd love to hear your thoughts. And again, if you guys have any questions or anything like that, I'll try to respond in a reasonable time frame. On that note, guys, I'll see you guys on the next one. Have a great one.